Welcome to Wealth Roadmap with Jeff and Steve, your guide to simplifying wealth management. Join us as we explore financial planning, taxes, investments, insurance, and legal frameworks to help you secure your financial future. All right, welcome everybody to episode 7 of the Wealth Roadmap with Jeff and Steve. Steve, do you have any icebreakers for us today? If not, I have one.
All I gotta say is I was waiting for you on this podcast, guys. Never on time. I'm always sitting here twirling my fingers. I'm glad you're able to make it on time, though, Jeff. Welcome to the podcast.
Well, you know what, Steve? Today we're talking about, as you well know, we're talking about RMDs, required minimal distributions, basically when the government forces you to take money out of your retirement accounts. There's been a lot of legislation changes over the years. They continue to push back the RMD age, so I decided to push back the podcast start time, Steve.
You can't do that.
Anyway, Steve, we're going to start off with a joke. Knock, knock.
Who's there, Jeffrey?
Boo.
Boo-hoo.
Why are you crying, Steve? RMDs aren't that bad. All right, let's dive.
Don't ever make another joke again.
So we have 10.
This is what I deal with, everybody, right here. This is what I deal with.
We've got 10. We've got 10 of the most popular concerns when it comes to RMDs. Again, there's been a lot of changes with the Secure Act 1.0, Secure Act 2.0. I'm sure the 3.0 is around the corner, but we're going to dive in today to RMDs. So again, if you are approaching retirement, you have money in a traditional IRA, a SEP IRA, a simple IRA, a 401k, a 403b. Many of these pre-tax accounts, those are all subject to required minimal distributions. Again, these are accounts that you have not paid taxes on. When that money got invested from your paycheck, or if you made a contribution, it did not get taxed by Uncle Sam. It went in there. And so if you're unfamiliar with how the government's running their business, so to speak, there's a deficit. So they need some tax revenue to fund all of these wonderful programs such as Social Security, Medicare, the defense, everything that makes the United States of America kind of tick. So they need that tax revenue. So that's why they're forcing you to take money out. Now, we're going to get into when you have to take it out, how much you have to take out and all that. But before we do that, Steve, why don't you tell us what happens if someone does not take out their RMD?
Yeah, that's the thing. So there's a penalty. There's a penalty on it if you do not take that RMD. Now, the penalty used to be 50%, meaning if you didn't take your required minimum distribution, you would have to give up 50% of that. Oh, and by the way, of course, it is taxed as well, right? Because it is a distribution from a retirement account. So thankfully, due to the Secure Act 2.0, the IRS came in, Congress came in, and they decided, that's a pretty steep penalty. Let's reduce that penalty. And they reduced now the penalty to 25% if you do not take it. Additionally, not only did it decrease the penalty for failing to take the RMD decreased to 25%, it can decrease to 10% if it is corrected in a timely manner. So that's kind of a big deal. I mean, think about that. You make a mistake, and previous to Secure Act 2.0, 50% is gone. IRS wants that as the penalty. 25%, 10% if it's corrected in a timely manner. If you're still employed, all right, so you're still working, and you're past your RMD age, you have a 401k, regardless of your age, assuming, again, you're past your RMD age, you do not have to take a required minimum distribution or an RMD from that current 401k that you're employed with. So keep that in mind, right? So if you're working and you're older and you have a 401k, you do not have to take that. However, if you do have other IRAs or previous company 401ks, or other types of retirement accounts where an RMD would be required, you would have to. So might be some calculation in there to be able to make sure that you take the proper RMD. You just wouldn't have to include your current employer's 401k balance in that calculation. So keep listening if you want to hear the next point that I'm about to make. It is going to be great. Go ahead, Jeff.
What a cliffhanger. So for, if my RMD is $10,000 and I don't take it, I'm paying a $2,500 penalty essentially.
That is correct.
Okay. Yeah, and that's not even a tax, right? That's just money that you lost. So, make sure you're working with a professional, whether it's a financial advisor, accountant, or just make sure you're on top of your stuff because, it's you probably would have paid somewhere around a 25% tax, if you would have just, taken out your 401k. So, last thing you want to do is being penalized on it. It's, you can't get that money back. A question that we get asked a lot is, can my RMDs be reinvested, or can I do a Roth conversion? I don't need the money right now. Like, can I do a Roth conversion, and can that satisfy my RMD requirement? And the answer is no. It does not satisfy your requirement for an RMD doing a Roth conversion. Now, it does not mean that you cannot reinvest the money. So if the government's going to say, hey, Steve, you need to take out $10,000 for your RMD, Steve is able to take out that $10,000, pay his fair share of taxes, and then reinvest it, whether it is a brokerage account, whether, it might be, paying down debt or anything like that. So it's not that, it's not like you have to spend it. It can be reinvested, but, the government, again, wants their, obviously their tax revenue. Again, Steve, going into the situation of, maybe I don't need it. What are some strategies to manage the RMDs?
Everyone's different. This is where the planning aspect comes into play, because you really want to get an understanding of what those RMDs are going to look like. And there's going to be a lot of assumptions being made. The biggest one is the rate of return, because the RMD is calculated based on the prior year's balance of your retirement accounts. But just a few to keep in mind: if you're charitably inclined and you are over the age of 70 and a half, a qualified charitable distribution, a QCD, which basically allows you to donate a certain amount of the RMD, up to a limit of your RMD, and you could direct that to a charity of your choice, a qualified charity. So by doing
Steve,
that,
does it have to be a qualified charity? Because I have 3 children, and we're taking donations over here at the Costello household.
Ooh, we're gonna have a problem with that one. You'll have to find a different way. It has to be a qualified charity, unfortunately. So the Costello household is going to be out of luck for this one, but I'm sure we could brainstorm to get some other ideas for that one.
Future episode.
So qualified charity, by doing a QCD, okay, a couple things you want to make sure is that the money goes right to the charity. Now, when I say right to the charity, I mean the check that you receive has to be made payable to the charity. A lot of times people do like to, give that check to the charity instead of having the check just sent to the, you certainly could have it sent to the charity, but there's no kind of personal interaction with it doing it that way. So you can certainly go ahead and get the check, but make sure the check is written in the charity's name. Very important. Very, very important. That's the first thing. The second thing is just keep good records, because when you get that 1099 at the end of the year, it's not, if you took out, I'm just going to throw out a number, $50,000 and $20,000 went to a charity of your choice as a QCD, that 1099 is not going to specifically notate that 20,000 went to the charity and 30,000 went to you. It's just going to give you a 1099 for 50,000. Whoever, whether it's you doing your taxes or your accountant, you want to make sure that you let them know, hey, this 1099 came through from, let's say it was from an IRA, from this IRA, 20,000 of that went to a charity. Please make sure that is adjusted when you do the taxes, because that 20,000 does not fall onto the tax return. Okay, so instead of having 50,000, remember, if I took 50,000 and I took 20,000 and gave it to the charity of my choice, the qualified charity of my choice, not the Costello household or his 3 kids, well then, that 20,000, I don't have to pay tax on it. So essentially, I've reduced my taxable income by 20,000, and only 30,000 is reported on my on my tax return. So I would say that is one major strategy. The other
Especially
thing
if
I'm
they're
going to
doing
do,
it, especially if they're doing it already, right? I mean, if they're already
exactly.
donating, right?
Yeah, without a doubt. I mean, whatever the amount, I've done it for my parents. Even if it's just a few $1,000s and you're donating it to a church, right, or wherever. In our minds, any tax savings is good. You're doing the same thing. You're just getting a benefit. You're not paying tax on that.
Yeah.
Because of that standard deduction, right, as of right now, is so high. It's really hard to get. For most people, writing a check to the charity of their choice, you're not getting a tax benefit from doing that. You're not getting a deduction because the standard deduction is so high. So if you're above 70 and a half, and if you are giving to charity and you're just writing a check, you're not able to get the benefit because most likely you're taking the standard deduction. Well, now don't write the check. Again, you're 70 and a half. You're able to pull part of the distribution from your IRA and then utilize that as as the QCD and give that to your charity of your choice. So that's the first thing. The other thing is, and as I was saying, Jeff and I were talking, we'll probably do a future episode to get a little more detailed on this. But the second thing is planning for those RMDs. We always say you have a runway from 59 and a half. That means that you're able to take out from your retirement accounts without a penalty. Okay. Prior to 59 and a half, and you take money out of an IRA, there's a 10% penalty. You hit 59 and a half, no penalty. So from 59 and a half to your required minimum distribution age, that is a great runway for planning opportunities to reduce those future RMDs. And that's where understanding what your RMDs are going to look like, that's where utilizing, if implemented properly, different strategies to help reduce those future RMDs could really come into play. So, I don't want to take away, because we could go down a rabbit hole with this one, Jeff. So just know the strategies are there, and it's just a matter of properly implementing them. And so that's where I'll leave it there. But as far as looking at, we talked a lot about the RMDs, right? And we talked about when you reach that age. Jeff, because that can get confusing. And since 2019, since the Secure Act 1.0 came out, and then the Secure Act 2.0 came out, since 2019, there have been significant changes, right? So in about 5 years or so, significant changes to the age at which someone has to take their RMD. So Jeff, let's clarify what, as of right now, what is that age?
I don't know, Steve. That's why I'm listening to this podcast. In all seriousness, right? Yeah, at one point,
There's another one, folks. It's what I deal with. He doesn't stop.
At one point it was 70 and a half, right? And that was pretty confusing for people. It's like, all right, well, like, when is my 70 and a half birthday? What if I take it out this year versus that year? And like Steve mentioned, there's been a lot of changes. Essentially the easiest way to look at this is if you were born between 1951 and 1959, right? If that's your year of birth, your RMD age is now 73. If your date of birth starts with, or the year is 1960 or greater, 1961, 62, etc., your RMD age is 75. So it's going to be pretty much either 73 or 75. We're not going to get into, most likely if you're older, obviously you're probably already taking your RMD. But that goes into, again, what Steve was just talking about. Hey, what's my runway before I have to start taking out these RMDs, right? And it's different for two people. I'm working right now with a client who's, one spouse is born in 1959 and the other one is born in 1961. They have different RMD ages. So in terms of, when they have to start pulling money out from their retirement accounts, it's going to be different.
Real quick, just to clarify, Jeff, too, because, great point. Used to be 70 and a half. And remember what I mentioned about the QCD earlier. It's still 70 and a half. And this is why I think it'll make sense to dive deeper on this on a future episode. But so the QCD at 70 and a half used to match with the RMD age. Well, as of right now, the QCD age is still 70 and a half, but the RMD age is 70, 73 or 75, depending on that year of birth that you have. So again, you can do a QCD and not be and not have to take an RMD. But of course, once you hit your RMD age, you can also do the QCD because you're older than 70 and a half. So sometimes there's confusion there, but I just want to make that distinction.
Yeah, and the QCD, right? It's obviously a strategy that you'd be looking at with your financial advisor to see if hey, does it make sense for me to do this now to reduce what I'm going to have to take out in RMDs in a few years? Again, depending on your age, but we always get the question, okay, hey, all right, great, Steve, I know my date of birth, I know that my RMD age is at 73 or 75, but how do I know what I'm forced to take out?
Was that a question or a statement?
That was more of a question, Steve. We're kind of going this back and forth. It's a podcast, so try to keep. I'm hoping that you're going to pick up what I'm putting down.
Yeah, I'm trying to work with what you got, but you're not setting me up properly. So let's
All right, we're
restart
going to
that.
ask a more direct question. Hello, Steve. How much? How do I figure out what do I have to calculate? What's the math for me to figure out what my RMD is?
Jeff,
Can you tell
I'm
me?
so glad you asked. I'm so glad. Yeah, the math it's fairly simple. Let's start with looking at. Let me just. Oh, you know what? I can't. I'm not going to share my screen. Don't worry about that. Okay, so I'll just go through it real quick. It's always going to be the prior year's balance of your retirement account. Prior year's balance. So depending on what that number is, it's the 12/31 of the prior year. So we're in 2024. If again, if you're of RMD age, you're looking at your balances for all your accounts, and we're going to get into specifics as far as how that does work. Of all your accounts, you divide the prior year's ending account balance by your remaining life expectancy. Well, Steve, what is remaining life expectancy? What is that? Well, the IRS, of course, they want to make everything as challenging as possible. They've come out with these life expectancy factors. And essentially, depending on how old you are, you will divide that by life expectancy factor. So if you're 73, that prior year's balance is divided by 26.5. 74 is 25.5. 75, 24.6. And what you notice is that life expectancy factor goes down. Obviously, you're getting older, so that goes down, which, simple math, you divide the top number of your balances by a declining number over years. And what happens is the percentage that you have to take out increases as you get older. So you actually have to, the IRS forces you to take more out of your account, out of your retirement accounts as you get older. That is, again, from a planning perspective, an important factor because most people don't really want to spend their money when they're older. They want to spend their money when they're younger. And again, we don't want to kind of go off the rails here and want to stay focused on RMDs, but just know that that's how it's calculated. As of right now, factors have changed in the past, especially when they changed their RMD age. But as of right now, it's very simple. You could simply Google it. Obviously talk to your financial professional. Reach out to us as far as to get specifics around that. But yeah, it's important to make sure that you do calculate that. And it's important to understand how they're calculated when you have multiple accounts. So if you have multiple IRAs, well, not a problem because you could lump them together. You can consolidate them in a sense. There could be 5 IRAs, and let's say each IRA is worth $20,000, $100,000. You could have 10 IRAs, and those 10 IRAs are worth $5 million. Whatever the number is, the RMD would be calculated on that full $5 million, but you'd be able to take the RMD out of one IRA. On the flip side, and same thing on if you have a 403B, for example. So here's an example. You have 5 IRAs, 5 403Bs. Well, you would have to take one RMD from one of those IRAs, and you would have to take one RMD from one of the 403Bs. You can't commingle the IRA and 403B, and you can't commingle 401ks, or if you have 457Bs, you can't commingle them. And the one thing about a 401k, the 457B, you have to pull out an RMD from each of those accounts separately, right? So IRAs, you could have multiple, and you can pull the RMD out from one IRA. Just make sure that you're including the full balance of all the IRAs. 403Bs, again, has to be separate, but if you have multiple 403Bs, include all the balances there, you can take that RMD from one 403B. Multiple 401ks or 457Bs cannot lump them together and just take from one 401k. You have to, or the 457B. You have to look at each account individually, whether 401k or 457B, and you have to take that RMD from that account. So it can be, logistically, especially if you have multiple 401ks, IRAs, or 403Bs, right? You can start to see it could begin to get confusing, and you can see where a mistake could happen, just from again, just simply an accounting or perspective where it's you just can't keep track and it gets challenging. So simplifying that is extremely important, because it just helps relieve some of the stress, the pressure, over making sure that you're taking the right required minimum distribution.
Yeah, and
So
especially if you have 3 or 4 401ks just lying around, and their government's forcing you to take money out of an account. Maybe you're 100% equities, and all of a sudden you're running into that sequence of return risk, right, Steve, that we kind of talked about.
yeah,
So yeah, not only is it going to be easier on you if you just consolidate all these old 401ks into one account, it's probably going to save you some money down the road as well.
absolutely. Yeah.
And like Steve mentioned, it gets higher as time goes on. I think around 90, right? It gets almost closer to like a 10% number, something
Just,
like that.
yeah.
And again, you can go to Google, you could find these tables, you could find many calculators to figure out what yours is going to look like. But the RMD is a floor, not a ceiling. So like Steve mentioned, if you only have to take out, let's say, 4% or whatever the number is, early on, you can always take out more. But the government is basically saying, hey, this is the bare minimum that you have to take out.
Yeah.
Because again, they want their tax revenue.
And quick, should probably just those quick disclaimer there. When I mentioned the life expectancy factors, that I was the 26, how you divide the account balance divided by the life expectancy factor. The ones that I was referring to, just know that was for use by unmarried owners or married owners whose spouses aren't more than 10 years younger, and married owners whose spouses aren't the sole beneficiaries of their IRAs. RMD planning can start to get complicated depending on the owner, but I just want to make that point clear.
Hey, Dustin. Hey, compliance. So awesome points. Now, Steve, right? Like, hey, I'm turning my RMD age. Do I have to take it out that year? Well, you can delay taking only your first RMD. You can delay until April 1st of the year after you turn your RMD age. For example, if you turn 73 in 2024, you'll have to take at least your first RMD from your account by April 1st of 2025. This only applies to your first RMD. However, while you're able to delay it into the next year, in that next year, you're gonna have to double dip. You're gonna have to take out 2 RMDs. So I'd have to, while I can delay my RMD for 2024 into 2025, now I have to take out my 2025 RMD in that same year as well. And so that might create a lot of trickle down effects in a tax perspective, in the sense that my income is now going to drive up because I have 2 RMDs that I took out. And so now does that cause my Medicare to go up in cost in 2 years? Does that cause my Social Security to get taxed more? Do I drive myself into a higher tax bracket? There's so many trickle down effects. So that, again, going back to like our first episode, you want to have a plan. So if it makes a lot of sense for you to delay it, great, you have that ability. But in most cases, we're seeing that it makes more sense for you to take it the year that you do become eligible for your RMD. Steve, talk to me about the cliffhanger. We're talking about Roth IRAs.
Yeah, here it is, everybody. Thanks for tuning in. So, Roth 401ks prior to the Secure Act 2.0, which came out in 2022. Basically, it's Roth 401k you had to take, again, Roth 401k, you had to take an RMD. However, well, if with Roth IRAs, the whole benefit there is number one, that they go tax deferred and tax free, and RMDs aren't required. But in a 401k, if there was a Roth portion in that prior to the Secure Act 2.0, they were. No more though. Since the Secure Act 2.0, Roth 401ks will no longer be required to take required minimum distributions beginning in 2024. So that's great. It's, it was kind of one of those weird, wonky rules. It's like, that makes no sense. Roth IRAs don't have to take it. Why Roth 401ks? Now, that's where planning comes into play, because if you move that money into a Roth IRA, in time, no one, if you do the right planning, you really shouldn't have had to take the Roth 401k RMD, because if you move that into a Roth IRA, you wouldn't have had to anyway take the RMD. But for those that maybe didn't or weren't sure, rest assured, if you have money in a Roth 401k, you do not have to, starting in 2024, which is this year, you do not have to take that required minimum distribution. So hats off to the IRS for making things right there. But here's the thing. RMDs happen. We know they're going to happen, and I think you kind of touched on this earlier, Jeff. What if you don't need the RMD?
Yeah, I mean, again, you could reinvest it into a brokerage account. You can use that money to, maybe pay the tax bill of a Roth conversion. Again, you can't use that as a Roth conversion, but again, you can still take out that money, utilize that money for, whatever expenses you may have, coming up. But, and we get that, question a lot, like, well, am I even going to need my RMD at that age? And again, that's where you want to do at least a forecast on retirement to try to figure out, hey, again, I'm 63 right now. If in, 12 years when I have to start taking out my RMDs, what am I looking at? Again, the rule of 72 basically says that you'll double your money, if you average a 7.2% return. So, over 10 years. And again, you want to try to forecast what your, like Steve mentioned before, right? You have that, that space, that roadway between now, however old you are, if you are 63, 64, and then until the time you need RMD. So yeah, if you have $1 million in your account now, they're not using that number for your RMDs. They're going to use the number when, you become that age at 73 or 75. So if you have $1 million now and you're 63, what if at 75, now you have $2 million? And now again, you have to take out roughly 4% or whatever that RMD factor is at that time. And now they're forcing you to take out, $80,000. So Steve, talk to us about, how someone can kind of be proactive, if they are, a little bit further away from that RMD age.
Yeah, well, so first I kind of want to, you hear often, and I remember hearing this, hey, put money away into the 401k, defer or reduce taxes now, defer them, because when you retire, right, you're not going to need as much income. You're going to need less income. Well, that's debatable, and that's, not everyone is the same. Some people want to live on the same amount, and some people don't. But here's the issue: is once the RMDs are going to happen. Okay, so you may have a lifestyle that doesn't require the income that you did pre-retirement, but you may have an income that could be double or triple, sometimes even more. We were working with a client. The RMDs were $500,000 eventually because of the money that they had saved and done extremely well saving. The point of the matter that I'm trying to make is, while your lifestyle may not require you to have the income that you did prior to retiring, you still may have a taxable income that is the same, if not higher, because of these forced required minimum distributions, which again fall to your tax return. So it's extremely important to understand the impact that they have. It's extremely important to plan for that, or at least just get an understanding. Sometimes it's just getting an understanding so that you could be prepared, and so that you understand the RMD and the tax impact that it could have on your Medicare premiums, on Social Security, capital gains. We live in a progressive pay-as-you-go tax system. It is dynamic, right? When you pull more income and when you have more income, you pay more taxes. And when you introduce provisional income with Social Security and Medicare, all these things when we retire that we have that we didn't have to worry about when we weren't retired, it could really snowball. And you could end up paying more than what you need to pay. You probably heard us talk about this. There are avoidable taxes and there are unavoidable taxes. Obviously, the unavoidable taxes are things that we have to pay. They're clear. But it's the avoidable taxes that, especially in retirement, that we want to try to avoid. Because if we're able to implement some of the strategies that allow us to either reduce or mitigate some of the taxes, that's more money in your pocket. It's less going to Uncle Sam. It's less money, it's less tax that you end up having to pay, which again, just makes the overall planning and your overall retirement a little bit more comfortable. And you have the confidence to know that taxes aren't going to eat into the retirement and really reduce the savings and the nest egg that you have. So, a lot of the strategies is stuff that you really want to do prior to hitting that RMD age is the best way to put it, right?
The younger you are, the bigger the runway, right? Like you mentioned before, right? So yeah, if you're 60 years old right now and you have 15 years, you have a way bigger runway to do proactive planning, whether that's, planning to do QCDs one day, whether it's doing Roth conversions. But if you're, I had a call recently with someone who, is 2 years away from RMD age, and she's trying to figure out what she can do to reduce her RMDs. And it's tough, because her runway is so much smaller. So, if you're if you're years away, this is the time to do proactive planning and incorporate a lot of the strategies that we've either talked about or will talk about on this podcast to hopefully put you in a better spot to create that wealth.
It's all about wealth creation, protecting and growing. Keep more for yourself and your family, less to Uncle Sam.
Yeah, the only family the only family member you want to, give money to is the Costello Foundation. We're going to create a foundation, a formal charity for those of you that are looking into the QCD strategies. But that kind of wraps up the RMD.
There he goes again.
There you go. That kind of wraps up the RMD, topic. Again, like Steve mentioned, we'll jump on another podcast to go over or do a deep dive into some of those strategies. But we hope this was helpful. Hope this, cleared it up. Again, when you're supposed to take it, trying to figure out how much you're supposed to take and from what accounts, again, depending on if you have multiple accounts and whatnot. And again, take your RMD, don't pay the penalty. And if you have any questions regarding RMDs, feel free to reach out to us. Otherwise, like, subscribe, and do all that fun stuff.
Yeah, Jeff, where is it that they could go if they want to quickly just reach out or have a topic or question?
They can go to the website, which is
wealthroadmappodcast.com.
Thank you, Steve.
Submit a question, submit a topic. That's the easiest place. But please, we've already gotten a few. This is why we're doing the RMD, because we had a bunch on questions on required minimum distributions. So let us know, and we'll definitely fit it into the schedule.
All right, guys, have a good one. We'll see you on the next episode.
All righty.
Thank you for joining us. If you enjoyed our podcast, don't forget to like, subscribe, and leave a comment on topics you'd like for us to cover on future episodes. We'll see you soon.
Financial planning and advisory services are offered through Prosperity Capital Advisors, PCA, an SEC-registered investment advisor with its principal place of business in the state of Ohio. One Team Financial LLC and PCA are separate, non-affiliated entities. PCA does not provide tax or legal advice. Insurance and tax services offered through One Team Financial LLC are not affiliated with PCA. Information received from this video should not be viewed as individual investment advice. Product discussions and illustrations are hypothetical in nature and will vary based on many factors, including but not limited to age, health, product, insurance carrier, and product design. You should consult the insurance carrier website and policy for detailed information. Content may have been created by a third party and was not written or created by a PCA-affiliated advisor and does not represent the views and opinions of PCA or its subsidiaries. For information pertaining to the registration status of PCA, please contact the firm or refer to the Investment Advisor Public Disclosure website. For additional information about PCA, including fees and services, send for our disclosure statement as set forth on Form ADV from PCA using the contact information herein. Please read the disclosure statement carefully before you invest or send money.